What if I told you that one simple tax planning mistake could cost you over $1 million? And I'm not talking about some hypothetical scenario. I'm talking about real people who made this exact mistake. Hey there, I'm Tiffany Phillips, CPA and tax strategist. And if you're a business owner who's ever thought, I don't really need tax planning yet, or my situation isn't complicated enough, this video is going to be a wake-up call. Today, I'm sharing two devastating case studies which show exactly what happens when successful entrepreneurs skip strategic tax planning. One person ended up owing $1 million in taxes on stock they couldn't even sell. Another lost over $200,000 in immediate tax savings because of one simple filing mistake. Before we dive in, make sure you hit that subscribe button and the notification bell because I share tax strategies like this every week that could literally save you hundreds of thousands in taxes. And if this video helps you avoid these costly mistakes, smash that like button. It really helps to get this information to more business owners who need it. Let's jump right in these shocking case studies. All right, let me start with a story that's going to make your stomach drop. A potential client came to me for tax planning, but he decided to wait until the next year to think about signing up. He figured his situation wasn't complicated enough yet to need tax planning. He could have been right, but here's what happened instead. At year end, he exercised incentive stock options on his own. Now, if you've done any research online, and I know many of you have, you'd think that if you don't receive the cash, you don't have a taxable event. And that's what he thought too. He was being smart by waiting 2 years from exercise to get capital gains treatment. But here's what nobody talks about on social media. And this is exactly why I get so frustrated with generic tax advice out there. When you exercise incentive stock options, you trigger something called an AMT adjustment. That's alternative minimum tax. And I bet you can't find one tax guru on Instagram explaining how to plan around AMT adjustment. This client triggered a $3 million AMT adjustment. Let me put that number on the screen so you can see it. $3 million. This created $1 million in federal income tax on stock he hadn't even sold yet. And here's where it gets absolutely devastating. By the time he showed up for his tax return and learned about the tax due, the stock had dropped to half its original value. So now he's holding stock worth 50% less than when he exercised the options, and he still owes $1 million in taxes based on that fair market value at the time of exercise. No deduction, no do-over, just a devastating outcome that standard tax planning could have prevented. You know what makes me angry about this? This wasn't some complex offshore scheme. This was a basic tax planning situation that any competent tax strategist should have caught. We could have reviewed the exercise timing, whether selling the stock sooner made more sense, and most importantly, how to avoid or offset the AMT. But by assuming his situation was simple, he paid tax on a $3 million of phantom income and doesn't even have the original value of the assets that were taxed. If you're watching this and you have stock options, please don't make this mistake. Comment below stock options and I'll make sure to create a dedicated video on how to handle this properly. Now let me tell you about the most common mistake I see with real estate. And this happens even when people have a CPA. This one is going to shock you because of how easily it could have been prevented. This client had what's called a self-rental. That means they owned a building personally and rented it to their business. Their accountant suggested a cost segregation study, which is actually a great tax savings tool when used correctly. It accelerates depreciation, which can create significant tax savings. But here's where everything went catastrophically wrong. The accountant filed the return without making something called a grouping election and treated the self-rental as a passive activity. Now, if you don't know what that means, don't worry. Your CPA absolutely should. But here's the devastating result. All of those losses from the accelerated depreciation were suspended indefinitely. They couldn't use them to reduce their taxes until they eventually found a way to generate passive income or dispose of the property. And here's the kicker that makes this even worse. You can't amend a return to make the grouping election if you didn't originally treat the activities as group. It's a one-time decision that has to be made correctly the first time. This client lost over $200,000 in immediate tax savings. And this was such an easy fix with such a catastrophic impact. This is exactly why I tell my clients that the difference between a tax preparer and a tax strategist can literally cost cost you hundreds of thousands of dollars in taxes. A tax preparer would have made the same mistake. A tax strategist would have known to make the grouping election from the beginning. And you know what's really frustrating? This client was paying for professional help. They thought they were covered, but their CPA was operating in compliance mode, not strategy mode. They were focused on getting the return filed, not on maximizing tax savings. If you own real estate and rent it to your business, comment real estate below, and I'll make sure you know how to avoid this costly mistake. Here's what I want you to understand from these two stories, and this is crucial. Tax planning isn't based on common sense. Small things that appear insignificant can be absolutely catastrophic to your financial future. In the first case, exercising stock options seemed like a simple transaction. You're not even getting cash, so how could there be a tax consequence? But that one decision created a $1 million tax bill. In the second case, it was literally a checkbox on a return. One election that wasn't made properly cost $200,000 in immediate savings. This is why I get so frustrated when I hear business owners say, my situation isn't complicated enough for tax planning yet. Your situation doesn't have to be complicated to create massive tax consequences. And here's what really gets me fired up. Most CPAs are operating in fear mode. They're so scared of the IRS that they won't implement strategies that could save you tens of thousands of dollars. They'd rather you overpay than risk any scrutiny. But here's the truth they won't tell you. 99.5% of the tax laws are written to help you save money on taxes. The tax code is a roadmap, not punishment. The wealthy don't have different rules, they just use the rules differently. Let me show you what I mean. The wealthy understand that every dollar you keep is a seed for your freedom. But if you don't have someone proactively looking at your situation from a tax perspective, you're essentially gambling with your financial future. Tax planning isn't a luxury, it's foundational, which is why someone should be reviewing your situation from a tax perspective before you make major financial decisions, not after. If this is resonating with you, hit that like button right now. It tells me you want more content like this, and it helps other business owners find this crucial information. Let me paint a picture of what waiting really costs you, because this is where it gets really expensive. Every year you delay strategic tax planning, you're not just missing out on current savings, you're missing out on compound savings. Think about it this way. If proper tax planning saves you $50,000 this year, and you invest that money at a 7% return, that's not just $50,000. Over 20 years, that becomes almost $200,000. But it's not just about the money that you could be saving. It's about the opportunities you're missing. When you're overpaying in taxes, you have less money to reinvest in your business, less money to hire that key employee, and less money to expand into new markets. I see this with entrepreneurs all the time, especially women entrepreneurs. They're bootstrapping their businesses, watching every penny, but they're hemorrhaging money to the IRS because they don't have a tax strategy. And here's what makes it even more frustrating. The solutions often aren't that complicated. In the stock option case, we could have done installment exercises, planned around A&T, or structured the timing differently. In the real estate case, it was literally one checkbox on a tax return. But timing matters. Tax planning is proactive, not reactive. Once the year is over, once the transactions are completed, your options become severely limited. This is why I always tell my clients, the best time to start tax planning was last year. The second best time is right now. You don't build wealth by making more money. You build it by keeping more of it. And keeping more of it requires a strategy. So how do you make sure you don't become one of these case studies? Here's exactly what you need to know to protect yourself. First, understand that tax planning and tax preparation are completely different services. Tax preparation is looking in the rear view mirror. Tax planning is looking through the windshield. If your CPA only talks to you once a year when it's time to file your return, you don't have tax planning, you have tax preparation. And as these case studies have shown, it's not enough to protect your wealth. Second, you need someone who understands that the tax code is written to help the business owners and investors. If your CPA is constantly telling you that strategies are too risky or that you should be grateful for high tax bills, you need a new CPA immediately. The wealthy don't pay taxes except on their payroll because there are so many tax laws written to benefit business owners. It's a totally different mindset from the compliance-focused approach most CPAs take. Third, you need quarterly strategy sessions, not just annual tax preparation. Your tax situation changes throughout the year as your business grows, as you make investments, as tax laws change. You need someone monitoring your situation and making adjustments in real time. Fourth, make sure your tax professional actually implements the strategies they recommend. I can't tell you how many times I've seen brilliant tax plans that never got implemented because the CPA was too scared to actually implement them. And finally, understand that this isn't just about saving money on taxes. This is about taking control of your financial future. This is about making sure you're building wealth instead of just generating income. Let me leave you with this. The two people in these case studies weren't reckless. They weren't trying to cheat the system. They were successful business owners who thought they were making smart financial decisions. But they learned the hard way that when it comes to taxes, what you don't know can absolutely devastate you financially. The first client is still dealing with the consequences of that $1 million tax bill. The second client will never get back those $200,000 in lost savings. These aren't just numbers on a spreadsheet. These are real people whose financial futures were changed forever by tax planning mistakes. But here's what gives me hope. These outcomes were completely preventable. With proper tax planning, both of these disasters could have been avoided. You don't have to be the next case study. You don't have to learn these lessons the hard way. If you're ready to stop gambling with your financial future and start taking control of your biggest expense, I want you to grab my book, Your Biggest Expense: How to Legally Pay Less in Taxes and Keep More Wealth. Go to yourbiggestexpense.com right now and get your copy. This book will show you exactly how to optimize your taxes before it's too late. It's packed with strategies that most CPAs will never tell you about, and it could save you thousands, or in this case, hundreds of thousands of dollars. Don't wait until you're facing a $1 million tax bill to take action. Don't wait until you've lost hundreds of thousands in savings to get serious about tax planning. Before you go, make sure you're subscribed and hit that notification bell so you don't miss any of my tax strategy videos. And if this video opened your eyes to the importance of tax planning, please share it with another business owner who needs to see this. What other tax planning topics do you want me to cover? Let me know in the comments below. And remember, it's not what you make, it's what you keep, so keep more.